Okay, this is going over that understanding financial statements, that handout for business 436. We're going to be talking about the income statement. So we'll turn to page 29, I believe. 29, the income statement at the bottom of the page. Okay, so we went over the balance sheet. The balance sheet, remember, is for as what your assets equal. The assets equal your liabilities plus your owner's equity. The balance sheet is as of a specific date. It's not for a like for a year or for 3 months. It's what your assets are and your liabilities and your owner's equity as of a specific date. Okay, that's different from a income statement, which is the cumulative financial income basically for a period of time, for either a month or a quarter, a year. It shows what your revenues minus your expenses were for that period of time. So even though it's done at the end of the quarter, it's for like the whole quarter, or if it's done at the end of the year, it's for the whole year. Whereas a balance sheet is just what its status is, what the balance sheet was at that specific date. Okay. Income statements also are referred to as profit and loss statements since they show the profit or loss, which is another, it's called a P&L, profit and loss. And it says, in addition, income statements show how much money the company spent to make that profit, which is what's called the profit margin, which is the amount of profit divided by the cost to produce that profit. So total cost to produce that profit. That gives you the percent of profit margin you're making. So again, revenue minus expenses equals your net income, or if you're losing money, net loss. Revenues are, of course, money that results from selling products or services to a customer. It can also come from investments or interest income from cash holdings. All that can be part of revenue. There's various costs or expenses from making, and there's different things like the cost of making and storing goods, depreciation of plant equipment, interest expense. They're all deducted from revenues. The bottom line is when you get your net income or net profit or net earnings, it's all the same thing. Okay? The cost of goods sold is what actually goes into the product if you're making a product, like the raw materials, if in the case of making furniture, something, lumber, any type of direct labor costs, those are all in the cost of goods sold. These are what was known in unit economics as the variable cost. There's what actually goes into that product that's being sold. Okay. By deducting the cost of goods sold from the sales revenue, we get the company's gross profit. Now, this is gross profit, not net, which is just a rough estimation of the company's profitability. When you're doing unit economics, remember, unit economics is by unit. You've got your revenue per unit minus your variable cost gives you your unit contribution. That was your gross profit per unit. This is overall, when you're talking about a company, their overall cost, the overall sales revenue minus their cost of goods sold, which again is their variable cost, gives them gross profit. Okay, then you subtract from that other costs, which are the operating expenses. Operating expenses like administrative salaries, rents, sales and marketing costs. These are from the unit economics handout. These are what's known as expected period costs, right? Your rent per month, your salaries per month. Remember, they're tied to a time frame, okay? And they do not, and it says they are not directly attributed to the cost of manufacturing a product. So these do not directly go into the product. You need the rent paid, you need the administrative salaries, you need the sales and marketing, but they're not the actual cost of producing the product. So they're just what's called SG&A, selling, general, and administrative costs. It's overhead basically. And you were for the unit economics, it was known as expected period costs. So expected period costs, SG&A, overhead, operating expenses, they all mean the same thing. Okay? whereas variable costs, direct costs, those are different. Okay, so this shows income statement for this hat company. A couple other things to take into account is depreciation, okay, which is an expense. And depreciation is a way of estimating the consumption of an asset or the diminishing value of equipment over time. So remember, you have an asset. When you put it on the books, you put its purchase price on the books as its value. Then you've got what's called a contra asset account, which is accumulated depreciation, and you subtract that from the historic purchase price of that asset, and you get what's called the book value of that asset, which is its purchase price minus its accumulated depreciation. So depreciation is another expense. There's different terms for things like EBITDA, which is earnings. This is supposed to be a B. EBITDA, earnings before interest, taxes, depreciation, and amortization. Amortization is like a mortgage is amortized, and it's basically a payoff schedule of debt. So, if they owe $1 million and they're paying $5,000 a month, they're paying their bonds down or something. That's what amortization is. They go through and use what's called EBIT on this, which is earnings before interest and taxes. So they don't take into account the amortization, and they take the depreciation out earlier. It all comes to the same thing. As long as you're taking those all out at the end, your net income will be the same. So for instance, they've got their retail sales and corporate sales. Corporate sales is just basically selling the corporation's retails to individuals. So the total sales revenue is $33,200,000. They subtract from it the cost of goods sold, which in unit economics is called the variable cost. That gives them their gross profit, which was their contribution margin, or unit contribution. Not unit contribution, but total gross contribution in this case, because it's times all the units. Less the operating expenses, which was your expected period costs in unit economics, which is basically overhead or SG&A, whatever you want to call it, operating expenses in this case. Then they subtracted depreciation. That got you earnings before interest and taxes. Then they subtracted interest expense. Then they got earnings before income tax. They subtracted income tax. And then they got net income. Okay. So it just says by subtracting operating expenses and depreciation from the gross profit, they get operating earnings. So operating earnings is when they've subtracted depreciation. They subtract that up here, right? Yeah, depreciation. So this is earnings before interest and taxes, EBIT. That's what they call operating earnings also. Okay. These earnings are called earnings before interest and tax. So that's their operating earnings. And then from that, they subtract their interest expense and their taxes. And that gets them net income. See, this is subtracted. There's your operating earnings. Then they subtracted interest expense and taxes and got a net income. And of course, interest is just what they're charged on loans that were taken out, and income taxes, obviously, when they're paying income tax. Okay, so here's a balance sheet for comparing 4 years. You can see their sales are continuing to go up. Their expenses are continuing to go up. Their gross profits continuing to go up. Their operating expenses have actually gone down, which is good because that increases their profit margin. Depreciation has actually gone down, so their earnings before interest and taxes has gone up. Their interest expense has gone down, so their earnings before tax has gone up. You subtract the income tax, and so their earnings have been going up. So income statements basically you can just basically tell how their profitability has been going. And obviously, the more it goes up, the better. Okay. And so that is the end of the income statement. We'll do the cash flow statement on a separate video.